What we're going to talk about today is term sheets, and the genesis of this is I have a book coming out June 4th, which you're welcome to pre-order, of course, on Amazon. And the purpose of the book is really to demystify the venture capital business for entrepreneurs. And so what I hope that you come away with after reading this is you as an entrepreneur have a better understanding of how does the venture capital business work, and therefore how do you as an entrepreneur interact with venture capitalists. But since term sheets is such a foundational element of the relationship between an entrepreneur and a venture capitalist, we want to spend a little bit of time today talking about kind of the economic issues inside of a term sheet and how you should think about those if you're negotiating a deal with a venture capitalist. What we're going to focus on today is the economic side of term sheets. So there's really two foundational pieces to a term sheet. We always talk about the economics because, look, who doesn't like to talk about money, of course? But the other big part, which we're going to defer for another day, is what we call governance, which is really who gets a say in what decisions around the corporate action. So do you get to vote on certain actions? Does your venture capitalist get to vote on it? Those are what we'd call governance issues. And we're going to put those aside for today and focus on the money issues, the economic issues. So to do that, we're going to kind of review some term sheet terms and try to help you understand what they mean, why you should care about them, and ultimately how you might make a decision between two potential competing term sheets for your deal. So we've got on the board here two kind of offers that you as the entrepreneur have been able to kind of get with two hypothetical venture firms. One in this column we're calling Haiku, and the other Indigo. We've protected their names to kind of protect the innocent here. So let's talk about kind of the different elements here that are relevant from an economic perspective. Number one is how much money are the firms proposing to invest? So as you can see here, the Haiku firm is talking about $2 million, the Indigo firm is $4 million. Now we're going to come back to that in a second and talk about why you might or might not be interested in taking more money from one of these investors. Probably the most foundational piece, though, of the term sheet is what we call the valuation, and you'll often hear venture capitalists use the term pre-money or post-money. These are actually fancy terms that are incredibly simple in their operation. Pre-money means exactly as the word sound, which is what is the company worth pre us putting in the money, before we put in the money. And so in this case, Haiku is telling us that your firm is worth $8 million, and interestingly enough, Indigo believes the same. So both firms here believe today, before the money goes in, that your firm is worth the same amount of money. Now post-money, again, is equally simple, which is it's just what is the company worth once we've actually put the money in. So as you can hopefully see here mathematically, the dollars that we invest plus the pre-money equals the post-money. So very, very simple math here. I didn't warn you there was going to be a math test here, but hopefully most of you remember arithmetic from elementary school. So post-money, as I said, really tells you, okay, once that money's gone in, what it's worth. And as you can see here, we have $10 million in this case and $12 million in the other case. That's simply a function of the fact that there are different amounts of money going in on the two companies. So again, we're going to talk about what that means in terms of how you evaluate that. And then the final couple of things I want to talk about before we explain how to interpret this is, number one, the option pool. So as you probably know, when you want to hire employees, many employees will want to have some equity ownership in the company to be able to participate in the potential upside of the opportunity. And so to do that, you will create what's called an option pool. And that means basically you're setting aside some percentage ownership of the company that you will give out over time to employees in the company. The venture capitalists in this case are saying, when we do this deal, we would like you to set aside, in the Haiku case, 20% of the company's ownership in the option pool, and in the Indigo case, 15%. And again, we're going to come back to that in a second and understand why those numbers are different and what they're intended to mean. The next term I want to make sure you understand is what's called liquidation preference. And the simple way to think about liquidation preference is it's the order in which money comes out of the company when we have a liquidation event. And normally a liquidation event means we sell the company. That's typically what we're talking about here. So there's a couple different flavors of this that I want to make sure you understand that are reflected in these two term sheets that we're talking about. First is this element here, which says 1x. That could be any number here. That could be 2x, it could be 3x. It's anything that you might negotiate with your venture capitalist. It's typically 1x, and what the 1 means is that the venture capitalist gets 1 times the money that they put into the company. Okay, so if this were 2x instead of 1x, then that would mean the amount of liquidation preference is 2 times $2 million or $4 million. It's very common to see 1x. Sometimes in later stage financing rounds, you might see higher numbers, but most of the time, we're going to see 1x. The second flavor then, which varies between these two term sheets, is whether it's participating or non-participating liquidation preference. And let me explain the non-participating one first, because I think that's the simpler one. It's also the more common one that you will see, particularly in early stages of companies. What non-participating means is that the venture capitalist gets a choice. When the company is sold, they can either take the amount of their liquidation preference, so in this case, they have a $4 million liquidation preference because it's 1x, right, times 4. Or they get to take the amount of money they would otherwise get if we considered them just a normal equity owner in the company, okay? And so the simple scenarios in which this comes into play, and I'm going to show you a diagram actually later in this session to help understand this, is let's take a very simple example, and let's say we sell the company for $10 million, okay? Let's say we've taken this indigo term sheet and we ultimately sell the company for $10 million. Now, under this liquidation preference, the venture capitalist has a choice, which is, do I take my $4 million first, or do I take the percentage ownership of the company I have and multiply it by $10 million to understand what my dollars should that I could come out? And as you may see here, roughly, this person has $4 million investment on a $12 million valuation. So that means, as you'll see in our next chart, that roughly they own about 33% of the company, okay? So if we sold the company for $10 million, then that would mean they would be entitled to about $3.3 million, okay? But remember, I told you they have a liquidation preference, which means they get a choice, which is, do I take my $3.3 million or do I take my $4 million? Obviously, any rational venture capitalist here is going to decide to take their $4 million, and so they're going to get a much higher value than they would have gotten just based on their ownership of the company. So this is where liquidation preference often comes in when you're selling the company, typically for a valuation that's lower than what the valuation is that the venture capitalist may have funded the company at. Now, participating is slightly different, and it's actually much more advantageous to the venture capitalist and, quite frankly, deleterious for the entrepreneur. We generally do not see it very often, particularly in Silicon Valley, but it's good for you to understand how it works. Remember, in non-participating, we said the venture capitalist gets a choice. They can take either the greater of their liquidation preference or the amount that they would otherwise be owed if they were an equity owner in the company. What participating means is they actually don't have to make a choice, but they get to double dip. In other words, they get to take their liquidation preference first, plus then they get to take whatever percentage ownership of the company would entitle them in terms of proceeds. So just to kind of keep this example here, if this one were participating, so if we assumed that this one were participating instead of non-participating, in this case, if we sold the company for $10 million, the venture capitalist would first get their $4 million, okay? And remember, we said we sold it for 10, so there's now $6 million left in the company. Then the venture capitalist also gets to get 33% of that remaining $6 million, which is roughly about $1.8 million, and that's an approximation. So now the venture capitalist is getting to double dip. They're getting to take both the $4 million in liquidation preference plus the additional $1.8 million. So as you can see, that's very harmful to you as a founder and your other shareholders, which is you now have somebody who's taken a much bigger portion of the proceeds of that sale than you might have otherwise anticipated. So this is one of these areas that you really want to pay close attention to. And as I said, I'm going to show you a kind of a graphical way to look at this in the next part of this presentation. The final piece, and then we're going to look at kind of the ownership of the company, is what we call anti-dilution. And what anti-dilution means is, this may not be a polite way to say it, but it's kind of schmuck insurance, quite frankly, for a venture capitalist. And what that means is that if I value the company today at $8 million, right, which is what Haiku's doing, and a year from now the company's not doing well, and some other venture capital firm says, hey, you know what, you thought it was worth 8, but I actually think it's worth 6 now. What the anti-dilution protection does for the venture capitalist is to cause them to get a price adjustment such that they get some benefit of that lower price against the shares that they purchased in this round. So it's kind of an after-the-fact thing that says, hey, it turns out we were wrong about the price as a venture capitalist. It's lower than we thought it should be, and we want some adjustment to make us as venture capitalists feel whole for that. Now, again, there's two flavors here, and we're not going to show you the math on it, and there's lots of things you can Google to understand the math. But the most common form of it is what's called broad-based weighted average anti-dilution. And the simple way to think about that, as I said, you can Google the actual math of it, is it's a partial adjustment. So it doesn't mean that we say, hey, all that $2 million that you invested at 8, we now take away the 8 and let's assume we're investing it at 6. But it kind of weights it, and it says, you know what, we're going to give you some credit for the fact that you put money in at 8. We're going to get some credit for the fact that you're putting money in 6. So you kind of get a blended average that reduces the price that the venture capitalist paid. It's still beneficial to them, but obviously not as beneficial. Now, the most beneficial is the opposite of that, which is what we call a full ratchet. And that really is a price reset, is the very simple way to think about it. So in the full ratchet, if we assume that were here in this case, this is actually what would happen is we would just ignore this $8 million price and we would say, you know what, forget that ever happened. Assume it never happened. Now all these numbers adjust. Instead of 10 million, it becomes 8. And so now this person gets the benefit of putting their $2 million in at a price that gets completely reset based upon the new valuation this new investor put in. So again, you can imagine, and this becomes very, very kind of problematic, that the lower this goes, the more kind of ownership goes to the venture capitalists, and you as the entrepreneur or your employees who don't have this protection, you get diluted kind of even further than you might have anticipated. So this is a term that I think most people don't spend a lot of attention on, but can actually have very material economic consequences, particularly in cases where the company may not be performing as well as could be expected. Okay, so now that we looked at the table of options, the next logical thing that you as an entrepreneur will want to do is to say, okay, what does this actually mean dollars and cents for me as a founder? And the simplest way to do that is to create a very simple table that you'll hear people call a capitalization table, or a cap table for short. And all that really is a fancy way of saying it's a representation of what does the ownership of the company look like once we actually take one of these term sheets, okay? So let's first look at the Haiku term sheet. So if you remember in the Haiku term sheet, they were offering us $2 million, right, on a $10 million post-money valuation, okay? And what I've shown here in this top chart is you as the founders end up at the end of the day owning 60% of the company. Haiku owns 20% of the company. Now, the simple way to know that that's correct is, remember, they said they were investing $2 million on a $10 million post-money valuation, right? So therefore, kind of, if your balance sheet doesn't balance or your table doesn't balance, this needs to be 20%. So that's just a good double check that you can make sure you've got it right. And then secondly, they told us in the term sheet that they wanted the option pool to equal 20%. Remember, this is the pool that we're setting aside to be able to give to other employees. So this gives you a sense of kind of what the ownership looks like. Now let's look at the Indigo one just for comparison, okay? So in this case, the first thing you'll notice is the founders own 51.7% of the company. Now, why is that? Why do we think there's a big difference between what you own in this case versus what you own up here? Well, there's two reasons. Number one is, if we look at the Indigo investment, they own a third of the company. And again, just to double check your math, remember they invested $4 million on a $12 million post-money. So obviously that needs to equal a third, which it does. So part of the reason they own more of the company is because they put more money in. So it's pretty simple math here, right? These guys only put in $2 million. The Indigo folks are proposing to put in $4 million. As a result of that, of course, understandably so, they want to own more of the company. And so therefore, a big portion of the difference between your ownership here versus there is a function of the fact that the Indigo venture capital firm owns a third of the company. Now, we got a benefit here, which is, remember, up here, we had to put aside 20% for the option pool. The Indigo team gave us a little bit of a break here and said, hey, we only need that number to be 15%. So even though we got reduced in our ownership as a result of this higher ownership by Indigo, we got a little bit of a benefit here as a result of the option pool, okay? So let's talk about just a couple things about, what do you do here? What do you choose? How do you know which one is better? Well, the short answer is it's actually a trick question because you can't know until you look through all the other relevant terms of the term sheet. But let's start with kind of what we know today to get a better sense. The real question here is it worth it for me as an entrepreneur to own less of the company today in order to get the additional $4 million? And so the question that you need to think about as an entrepreneur is, what would I do if I had $4 million instead of $2 million? So one way to think about that is, does it de-risk the business for you? So in other words, if I say, look, I'm going to invest $4 million in the company, and maybe that gives you 18 or 24 months to try to build the business instead of the $2 million only lasts 12 or 18 months, you might say, that's a trade-off I'm willing to make, because that means that it de-risks the chances that I can achieve the objectives I want to achieve when I need to go raise the next round of financing. The flip side to think about it is, if you took $4 million instead of $2 million, what more could you do over that same period of time? So how many more accomplishments, how many more objectives could you achieve as a business? And therefore, you might be on a better trajectory when you go raise the next round of financing to be able to show that next round of investor all the things you've accomplished. There's no right answer to this, as you can imagine, but this is kind of the calculus that I think you as an entrepreneur need to think about is, what could I do with that extra money, and would that benefit me in terms of the next round of financing and the opportunity set I would have? Or do I feel like I need more wiggle room than the $2 million gives me, and therefore I'm also willing to accept that dilution? Okay, that's one important thing to think about here. The second thing is to look at these differences in these option pools. Now, it may be the case that it's hard to know if 20% or 15% is the right number. In some respects, these are kind of made-up numbers by the venture capitalists. But the kind of heuristic that venture capitalists often use to determine what size they want is they're trying to say, look, when I invest in this company, I want this option pool to be able to last you for all the hiring that you're going to do for at least until the next round of financing comes in. So that's why you often do see differences between the option pool here. And in this case, maybe the Haiku people believe that you're going to have to hire a lot more people and or you're going to have to give them a lot more equity. And so therefore, they want to make sure you've got a big enough pool to do so. Okay, so that's the other kind of lever that you can think about here that has an impact on your overall ownership. Okay, so there's one last piece of this puzzle that I want to kind of share with you, which is, this is great. This is kind of a static picture of what the capitalization table looks like today. But the real question is, what does it look like potentially when you sell the company or when you achieve what the venture capitalists call a liquidity event, which is when you as an entrepreneur and your employees and all the venture capitalists hopefully see the fruits of your labor. So I'm going to turn this around to show you kind of what we call a payoff matrix. And again, this is a very simple way to think about, okay, in different scenarios, what do I as a founder, and we're going to represent that by what we call the common shareholders, because that's the type of stock the founders hold. What do I get in a certain scenario, and what do the venture capitalists get? This is also a good way for us to illustrate what the economic term we talked about before, which was the concept of liquidation preference. So remember, we talked about that, which is kind of an order of proceeds, who gets what when. This graph kind of allows us to visually describe that in a way that helps you understand the trade-offs. So let me just take you through this top one first, okay? So the first piece of this to understand is this graph here, of course, is the investor. So what this shows me, if I just look at this first segment of the line here, says for any price at or below $2 million, the venture capitalist gets all that money, okay? So does that make sense? Because that was the concept of a liquidation preference, right? They're investing $2 million, which means the first $2 million of the company always comes out to them and goes to the venture capitalist. So this is what the venture capitalists get. So that means you as a founder and you as an employee along this whole portion of the curve here, you get nothing because all $2 million of that proceeds are going to the venture capitalists, okay? And then remember in the Haiku case, we had what's called participating preferred, and I kind of used the concept that that's kind of like double dipping, which means in addition to getting their $2 million, Haiku also then gets to participate as an equity investor in the company. And you can recall from the other side of this graph that we showed, they own 20% of the company. So that means for any amount of money above 20%, in addition to their $2 million, they also get to take 20% of the proceeds of the company, okay? And so this is kind of a graphical way to think about kind of how this works. And so you can see kind of, this is roughly kind of the break-even point for you as a common shareholder where you start to kind of participate in a much more meaningful way for the economics of the business. Now, in contrast, if you look at this at the Indigo side, we talked about in the Indigo side, they have a 1x non-participating liquidation preference. So remember, their 1x was $4 million because they put $4 million into the company. So you have this same general graph here, which is for the first $4 million of the company, 100% of that goes to Indigo, okay? And so again, you can see for you as an entrepreneur and for your shareholders, you will get nothing until the company sells for a value that's greater than $4 million. Now, the other interesting piece here to look at is this flat line between $4 million and $12 million. And the reason for this is, remember, in this case, because it's non-participating, the investor doesn't get to double dip, okay? So let me just give you a very simple example here. At a $10 million sale price, then remember, in this case, the investor owned 33% of the company. We used this example earlier in the video, which would mean if they just took their percentage ownership, they would be entitled to $3.3 million, okay? But remember also we said, which is true, is they have the choice of taking the greater of their liquidation preference or $3.3 million. So of course, any rational investor will take their $4 million, okay? But if we contrast that with, if we said we were selling the company for $15 million, and again, they get 33% of that, that's roughly $5 million, right, is what the answer is. Now, their ownership of the company at $5 million is obviously greater than $4 million, so they will choose this. And because, as we said, it's non-participating, they don't get to do both. They have to pick one or the other. So what happens here is between prices of 4 and 12, as you can probably see from a mathematical perspective, they're always better off just staying with their liquidation preference because their percentage ownership in the company doesn't yield them any more dollars. So the investor has this weird kind of flat line, which is they're kind of indifferent, right? So it doesn't matter to the investor if I sell it for $4 million or if I sell it for $11.9 million. I, as an investor, am always just going to take my $4 million. And so this is kind of an interesting artifact of this kind of non-participating liquidation preference. And then it's only above this price of $12 million, where in all cases, they will just take 1/3 of what they're entitled to as an equity owner of the company. So I know I've thrown a lot at you in a very short period of time, and the terminology sometimes can be confusing here. But what I hope you got out of this is a couple things. Number one is we focused on economics today only. And there's a whole other section that we have to care about, which we call governance, right? Who gets a say in what things in the company? If you read the book, you'll get a full rendition of that, and so I hope you'll take the opportunity to learn about that as well. From the economics perspective, though, I hope the key takeaways here to think about are, how do you understand trade-offs between taking more money or less money potentially in the future? How do you think about what that means for you from an economic ownership perspective in the company? And then importantly, how do you have a general visualization based upon things like liquidation preferences for how to think about who's going to get what kind of money depending upon the type of outcome that the company has?